Hi traders, I'm Lance Beggs from YourTradingCoach.com. Welcome to the second video in our series, the YTC Introduction to Trading Technical Analysis. In this video we'll be exploring two topics, the aim of market analysis and a quick overview of the main methods used to conduct analysis of the markets. Before commencing this course, please familiarise yourself with the disclaimer at the following webpage, YourTradingCoach.com/disclaimer.html. If you're unsure about the contents of the disclaimer, please contact me via support@YourTradingCoach.com. Of particular note is the following. The information we provide is general comment only for the purposes of information and education. Nothing we provide should be considered advice, and please seek professional advice as to whether or not trading or investing is suited to your particular circumstances. As mentioned though, please refer to YourTradingCoach.com/disclaimer.html for the full text. Let's start with the aim. I see two primary aims of market analysis. The first being to identify a bias for future price movement. What direction is price most likely to go? There are no guarantees, of course. We don't have all the information and we never can have all of the information. We're aiming, with the information we have available, to identify the most likely direction. Apple stock is currently priced at $593.70. We analyse the market to determine the most likely direction of price from this point. Is it likely to be bullish, which is a term used to refer to an increase in price? Maybe we expect it to increase to $600. Is it likely to be bearish, which is a term used to refer to decreasing price? Maybe we expect the price to drop to $550. The British pound US dollar forex pair is currently priced just over $1.60 at 1.60305. We analyse the market to determine the most likely direction of price from this point. Is it likely to be bullish and rally to higher price levels, maybe $1.65? Is it likely to be bearish and fall to lower price levels? Maybe our analysis says price should drop to $1.50. Or is it likely to remain neutral and remain in the vicinity of the current price with little change? E-mini S&P futures contracts are currently priced at 1404 3/4. We analyse the market to determine the most likely direction of price from this point. Is it likely to be bullish, resulting in price rising, perhaps to 1420? Is it likely to be bearish, resulting in price falling, say down to 1400? Or is it likely to remain neutral, resulting in price remaining around this same level? So the first aim was to identify a bias for future price movement. Do we expect price to rise, to fall, or to remain neutral? As far as some people are concerned, this is the sole aim of market analysis. However, because we're traders and not analysts, and therefore because we wish to actually profit from the resultant movement of price, rather than just be able to say we picked it, I prefer to add a second aim for our analysis. That is, to identify trade opportunity within the expected price movement. This will include an entry point and an exit plan, and the exit plan including a plan for when and how we exit with profits, and also a plan for when and how we should get out if our analysis proves wrong. For example, on completion of your analysis, you might determine opportunity to be as follows. My analysis says that Apple will rally from here. If it can break and hold above $600, then it's a buy with an expectation of reaching a target price of $650. And if price falls below $600, I'll know I was wrong and so will exit in order to minimize my losses. My analysis says that the British pound is likely to fall. I should sell now as it's likely to move to at least $1.59 quite quickly. My initial stop loss will be at 1.6040. When price reaches $1.60, I'll move the stop to break even and let the trade run with a 40 pip trailing stop. My analysis says that the E-mini S&P will remain steady at or around this current level. There is no trade opportunity here, it's time to look elsewhere. Again, they were examples, please don't make those trades. So our two aims are to identify likely price movement within the market and to identify potential trade opportunity. So how do we achieve our aims of identifying a market bias and trade opportunity? There are two primary methods used by market participants. The first being fundamental analysis, which I'll also sometimes refer to as FA, and the second being technical analysis, which I'll conveniently abbreviate to TA from time to time. A simple way to differentiate the two, just quickly, is by looking again at the image we examined earlier from our trading platform. Fundamental analysis is a study of the factors affecting the instrument itself. In this example, that's a study of the factors affecting Apple as a company. While technical analysis is a study of the patterns in price and volume. But let's look in a little more detail. Let's start with fundamental analysis and its definition. Fundamental analysis is analysis of the factors associated with the tradable instrument and the environment in which it exists to determine the instrument's value in the belief that price will eventually move towards this value. So for example, we have Apple at $593, but if our fundamental analysis of the company and the market environment concludes that Apple should be worth $650, then it's currently undervalued at $593 and we should buy the stock. But if our fundamental analysis concludes that Apple should only be worth $500, then it's currently overvalued at $593 and we should sell. The factors you analyse will vary based upon the type of instrument. For most instruments, whether stocks or futures or currencies, you will want to study the economic factors that will potentially influence your assessment of value. This might involve a study of employment figures, interest rates, retail sales, GDP, consumer spending, FOMC statement and minutes, and much, much more. For many instruments, you want to study the industry-specific factors which may potentially influence your assessment of value. This might involve study of customers, competitors, suppliers, technologies, mergers and acquisitions, inventories, and in some cases the environmental factors which may influence value, such as crop reports and long-term weather forecasts. For individual stocks, you'll also want to examine the information at the company level, again to allow you to assess the value of the stock. This may involve study of balance sheets, profit and loss statements, company prospectus, management, who are they and what's their track record, dividend yield, PE ratio, capitalisation, and debt to equity ratios. All in all, it's a whole lot of work to become a competent fundamental analysis. The problems with fundamental analysis are many. First, price does not actually move based upon fundamentals. To touch on the surface of one of our advanced topics, for much later on, it actually moves based upon supply and demand and the sentiment within the marketplace. Just because your analysis says price should rise, if a big enough contingent of the marketplace are desperately selling because they have a differing view, then price is more likely to fall. Even if they're wrong about the fundamentals and you're right, supply and demand move the market. And the fundamentals may well influence supply and demand, but the market does not move to your fundamentally assessed price just because you think it should. Second, there is too much information. You can't and don't know it all. So what have you missed, and how important is that missed information in determining future value? And even if you did get it all right, what if everyone else didn't and they were missing the vital information? Again, the reality is that price will go where supply and demand tells it to, and so if everyone else believes price is going down while you believe it's going up, then you're wrong. Third, not only is there too much information, often you'll find that information will be conflicting. Fourth, you do not have any proof of the accuracy or reliability of the information. Just ask those who invested in Enron. And fifth, the information, even if accurate at the time of the release, may no longer be relevant. You're assessing value based upon historical information. Perhaps the last annual report, or even if it's quarterly, it's still old information. Projections forward are simply a guess based upon the best information the company had at the time, and perhaps those projections are now wrong based on what has occurred since. You won't know that because you're basing your work off historical information. But the main problem with fundamental analysis is timing, or more specifically, the inability to accurately time your analysis. For example, our analysis might say that Apple is currently $593. We believe it is undervalued, it should be $650. Apple is therefore a buy, as its price should adjust over time to its proper value. This is a price chart of Apple, and while we don't cover price charts in detail till the next video, for now it's just a display of how price changes over time. Apple here was trending downwards over the last few months and then rallied to its current price of $593. Let's say, for example, that our fundamental analysis says price should continue up to $650. But as you'll see with its path to $593, price doesn't move in straight lines. Let's assume that we are correct and that price will eventually get to $650. What if it takes 6 months of sideways movement for enough people to perceive Apple as a buy in order to then drive price higher to our target of $650? Are we willing to keep our money in an unproductive investment or long-term trade for 6 months, waiting for this price spike to $650? Or would our money be better off elsewhere in a better performing market, with us buying Apple only when it starts rising above the current stall point? Absolutely it would, but fundamentals can't time the market in this manner. Or even worse, what if the path to $650 requires that price first falls down to $450 before enough buying steps in to take it higher? Are we willing to hold through this drawdown to $450? If so, how low are you willing to take it before you revise your analysis and consider the fact that you may be wrong? Price may well go to $650, but if it's going to $450 first, then buying at $593 was a really bad idea from a timing perspective. And that's the problem with FA, fundamental analysis, in my opinion. The inability to accurately time your analysis. The second of the main methods of analysis is technical analysis. TA is analysis of current and historical price and volume in order to identify patterns which indicate likely future direction. The main tool used in TA is the price chart, as seen briefly a few slides ago. We'll examine them in detail in the next video, but for now it's simply a chart showing how price of the market has changed over time. The concept behind TA is that firstly, price is a representation of the sentiment of the market participants. A price rise is a result of buying pressure, overwhelming selling pressure, or net bullish sentiment. A fall in price is a result of selling pressure, overwhelming buying pressure, or a net bearish sentiment. And trader sentiment is a result of their perception of future value of the market. As such, technical analysts argue that they don't need to study fundamental analysis, as the price is a reflection of all known information, fundamental, political, psychological, or otherwise. All traders, after analysing all information they have available to them, make their buy and sell decisions, and that creates the current price and price movement. You could say that charts are a representation of the psychology of the marketplace. And because human behaviour and decision making follows repeated patterns of behaviour, we also see repeating patterns of behaviour within price movement. Trends tend to persist, and patterns, such as shown here and here, tend to be somewhat predictable. Not perfect, but enough of an edge to allow us to identify a bias for future price movement and to identify trade opportunity. But by far, the main advantage of TA over FA is the ability to time our trades. No longer are we subject to analysis that might take weeks or months to show results in the market. Price falls, produces a flag pattern. The break of the flag pattern triggers a sell. Price falls again, produces a second flag pattern. The break of the flag pattern triggers another sell. Through our charts, we get immediate, real-time information about the current sentiment of the market and the current direction of price, and we can time our entry into the market and out. And we can do this on daily charts if we wish, or any other time frame, right down to 5-minute charts as shown here, or 1-minute charts, or even lower. Still, TA is not perfect. There are problems. First up, there is some degree of subjectivity, especially with chart-based analysis. Let's say, for example, that our analysis identifies a downtrending market, so price is falling as shown here. But we believe that the down move is due to end, so we plan to buy on the first sign of price breaking above the downsloping trend line, which is shown here as the dashed line. Are we best then positioning our trend line close to the tops of price as shown here, where it hugs tightly against the red and green candles? If we did, then we didn't get a good buy. as price moves sideways from our entry point. Were we perhaps better then waiting for this more conservative line, drawn touching the price peaks here, here, and here? Again, if we did that, we were wrong, as price continued to move sideways and then further down. So where is the correct place to draw the trend line? The first one, the second one, or the third one? Subjectivity means that different traders will identify their patterns in the market in slightly different ways, achieving different results. There is no right or wrong, only how we perceive the market and whether we can make money from that or not. Beyond subjectivity, we also have a problem of pattern failures. Price is gapped higher on the open of a new session in the Nasdaq, forming a pennant and then breaking higher above that pennant. We'll talk about what these patterns mean in coming videos. For now, just accept that common TA expectations are for price to move higher from this pattern. Obviously that didn't happen. Perhaps our assessment of market sentiment was incorrect. Perhaps we've missed some information, or perhaps the sentiment has changed due to some external and unknown factor since the time of the pattern breakout. Either way, patterns do fail, and this is something we need to learn to manage in trading through technical analysis. A little hint for future reference: failed patterns are great information and can often lead to nice trade opportunity against the original breakout direction. And thirdly, we have a problem with lagging indicators. We'll learn indicators in a future video, but a common method used by many traders is to use these indicators as triggers into or out of a trade, so using them for buy or sell decisions. For example, this chart shows red and green lines called moving averages. A common assumption is that a crossing of the lines, as shown here in the red circle, indicate a change to a bearish market, and so amateur traders will be seeing this as a sell opportunity at this point here. The market is now falling from its prior highs. It's time to sell the market. As seen though, the indicator signal occurred way too late. Rather than selling up here, the lagging indicator signal told you to sell way down here, after the move was over and right at the time you should have been buying. So TA is not perfect. We have subjectivity, pattern failures, and lagging indicators. And beyond these problems, you'll also discover there are many challenges in being able to use it consistently to take profits from the markets. In many respects, it's more of an art than a science. But none of these are insurmountable. In this video series, and certainly in the advanced webinar or video series which will follow, we'll address these problems in more detail. The end result of all this is my preference for market analysis, which is of course technical analysis. The advantages TA provides in terms of ability to get real-time feedback and to accurately time the market make it vastly preferable to fundamental analysis, in my opinion. Let's look at an example. Here we see price is held at an area of support, then broken strongly down and pulled back to retest the breakout level. Technical analysis tells me that a retest of a breakout of support provides a high probability of continuation lower. This breakout pullback is a great indicator of bias and of trade opportunity. You won't understand this chart yet, we'll get to that later. For now, just see it as an example of how TA allows us to identify, at the point of the red circle, a bias for lower prices and trade opportunity in the short direction. Technical analysis allows us to achieve our two aims: identifying market direction and identifying trade opportunity. Similarly here in this next example, on the left hand side, prices rallied this time up through a prior resistance level and pulled back to retest the point of breakout. At this point, identified by a blue circle, technical analysis allows us to see a bias for higher prices, a trade entry point long here, location for price targets here and here, and an initial stop location below the pullback at this point here. And on the right hand side, a lower time frame chart, technical analysis provides us with locations to trail our stop loss here, then here, here and here as price rallies to the target. Again, you won't understand the detail in this chart just yet. For now, just see it as an example of how TA again allows us to identify, at the point of the blue circle, a bias for higher prices and trade opportunity in the long direction. Again, technical analysis allows us to achieve our two aims: identifying market direction and identifying trade opportunity. Now, having said all this, it is quite possible to combine the two if you so wish. The question of which to trade is not necessarily a question of one or the other. There are some pure technical traders, and there are many investors who focus exclusively on the fundamentals. As a trader, though, this does not mean that you must only use TA. Many traders operate with a combination of the two methods. The most common way being to use fundamental analysis to narrow down the larger universe of potentially tradable instruments to those that are most fundamentally strong, and then using technical analysis methods to trade them from the long side or buy side, in the expectation that they'll rise in price, or to identify fundamentally weak instruments and then use technical analysis methods to trade them from the short side or sell side in the expectation that they'll fall in price. The focus of this video series is on technical analysis only, but there are options to use both if you wish. Even if you're a technical analyst at heart, as I am, with no interest in fundamentals, I would highly recommend you don't completely ignore them. One aspect that you should consider is the following. Be aware of the planned timings for potential market moving events, for example shown here. Calendars are released well in advance, providing the date and time for significant economic releases, political and economic meetings or speeches, or company earnings reports. These events carry the potential to shock the market, so awareness of the event timings can allow us to appropriately manage risk if we have an open trade, and awareness of the timings can help us prepare for the potential trading opportunity available after the news release. News can move markets, and we require market movement for profits, so be aware of timings. The resources page at my website, yourtradingcoach.com, links to the current calendar which I use for my trading. We'll discuss news trading in slightly more detail later in the section on strategy. Beyond fundamental and technical analysis, there are also other methods you may find appealing. Yes, you did read that correctly. It does say planetary cycles. Some traders do use planetary cycles and lunar phases and other such techniques in the process of analysing the market. I am not going to touch this. It's way beyond the scope of this course. Whether you believe in astrology or not is up to you. If you do use astrology in other areas of your life, then you may well want to explore this further. The one positive, in my opinion, is that such analysis is typically used in conjunction with either TA or FA. It's rarely a standalone method. Of course, I would suggest that those trading with this successfully are more likely to be achieving positive results as a result of their effective skill in TA or FA, and not from the planetary cycle analysis. But then why mess with something that's working? If you like this stuff and want to use it and can profit from it, then I'm not going to argue with that. Go for it. Something with much more promise is sentiment analysis. You'll sometimes see this included under the umbrella of TA or FA in some books or websites. That's fine. Depending on how it's done, it does have overlap with both fields. I prefer to keep it separate. You'll recall that I said that a price chart is a representation of the sentiment of the marketplace. Sentiment analysis is an attempt to gain a more direct insight into sentiment before it becomes evident on the charts. Sometimes the intent will be to trade in the direction of that sentiment. Often, though, it will be traded in a contrarian manner. When your sentiment indicator identifies extreme bullishness, that is considered unsustainable, and so the more astute trader should be selling. And when sentiment indicators identify extreme bearishness, again that is considered unsustainable, and so the more professional sentiment analyst and trader will be looking for a buying opportunity. Sentiment analysis is not something new. It's been around for many years through various forms of market indicators and reports. For example, you may have heard of the monthly Commitment of Traders report, a small part of which is shown here in the video. But sentiment analysis is a method with some real growth potential in my opinion, due to recent increases in the social networking connectivity of the trading community. Various firms are currently working on the concept of data mining the social networking sites in order to build an accurate and timely picture of sentiment. Further study in sentiment analysis is beyond the scope of this video course. Our focus is basic technical analysis. But bookmark the topic for something to explore later if sentiment analysis seems of interest to you. Again though, I'd highly recommend any trading with this information be done with a combination of both sentiment and technical analysis methods. Let's wrap up this video with the key points. The aim of market analysis is 1. to identify a bias for future price movement, and 2, to identify trade opportunity within the expected price movement. And I prefer to analyse the markets through a technical approach. I accept that price reflects all known information, and that includes the fundamentals. I accept that price is a representation of the sentiment within the marketplace, and as human nature and human behaviour are subject to repeating patterns of behaviour, so too will price. Trends tend to persist, and patterns tend to repeat. The result of this is that technical analysis of price charts provides real-time feedback and the ability to accurately time our interaction with the market. Technical analysis is the most effective method I'm aware of for achieving our two aims: identification of market bias and identification of trade opportunity. So let's start looking at TA in some detail. Coming up next, Module 3, Technical Analysis Tools, in which we examine the construction and component parts of a price chart. And we'll look at the various categories of technical analysis. I'm Lance Beggs from YourTradingCoach.com. Thank you and happy trading.